Across a full century of economic devastation, a strange and unsettling pattern keeps resurfacing, something so consistent, so quiet, so mathematically defiant that it almost feels engineered. Think about what the last 100 years have really looked like: the Great Depression, where equity wealth was butchered by an 89% collapse; the 1970s stagflation, where inflation stalked bondholders like a slow-moving but unstoppable predator; the 2008 financial implosion, which vaporized $10 trillion in household wealth; the COVID crash, a 35% freefall packed into just 23 trading days; and finally, 2022, where growth stocks once worshipped were taken out back and shot, many losing 70% of their value. 5 crises, 5 entirely different triggers: deflation, inflation, financial system failure, pandemic panic, and an interest rate shock that ripped through markets like a controlled demolition. Yet through all of that destruction, 3 simple portfolio positions, not exotic derivatives, not hedge fund wizardry, not 20 instrument diversification charts, survived every single one of these catastrophes. And not by luck, by design. The same positions that protected investors in 1929 also worked in 1973, in 2008, in 2020, and again in 2022. Warren Buffett holds one of them so aggressively that nearly 30% of Berkshire Hathaway is currently sitting in that very position. Another is being hoarded by central banks at a pace not seen since the 1950s. And the last one has quietly compounded at roughly 10% per year for an entire century, regardless of the bloodshed markets endured along the way. Most investors never see the pattern. They chase shiny objects, surrender to fear at precisely the wrong moment, and mistake volatility for danger while missing the deeper story unfolding beneath the surface. But if you understand these 3 positions, the only 3 that consistently lived through a century of economic violence, then you gain something. No investment bank, newsletter, or guru can sell you not certainty about the next crisis, but certainty that you will survive the next crisis. The reason almost every investor fails is that they cling to a single idea of safety. In deflation, they want cash. In inflation, they want hard assets. In expansions, they want stocks. But reality doesn't obey human preference. Markets operate under 3 fundamental states: compression, debasement, and expansion, and history shows that crises are never pure events. They mutate, they shift, they break one system while inflating another. And that is exactly why no single asset can protect you from everything. What emerges instead is a triad, 3 distinct defenses that each address one of the core monetary states. The pattern is not philosophical, it is mechanical. Deflation makes liquidity king. Inflation makes anything printable worthless. Growth makes productive assets accelerate. And every crisis of the last 100 years can be mapped into one of these states or the violent transitions between them. The Great Depression was a pure deflationary collapse. The 1970s were a slow-motion inflationary breakdown. The 2008 crisis began with deflation and then flipped into inflation when central banks printed trillions. COVID was an accelerated echo of the same script: 3 weeks of deflationary horror, followed by stimulus-induced inflation. And 2022 was the opposite transition from inflation back toward tightening-driven deflationary pressure. If you only hold one asset class, you're betting on a single climatic outcome. But if you hold these 3 cash/T-bills, physical gold, and broad equity ownership, you aren't predicting the weather. You're preparing for all of it. This isn't a growth strategy. It's a survival architecture, and survival is the only condition from which compounding becomes possible. To understand the power of these 3 positions, you have to walk through the timeline, the long corridor of crises stretching from 1929 to 2022, and examine how each position endured. The story begins in the Great Depression, the most violent deflationary collapse in modern American history. At the time, the dollar was backed by gold at $20.67 per ounce, and as stocks plunged 89% from their peak to their 1932 trough, something counterintuitive happened. Cash gained purchasing power. Prices collapsed, debt suffocated borrowers. Real estate dropped by about 50%, but anyone holding cash or treasury bills survived. Treasury bills paid 3-4% interest while prices dropped roughly 25%, generating real returns north of 28%. Then came Roosevelt's 1934 devaluation, revaluing gold from $20.67 to $35 per ounce, a 69% overnight gain for anyone holding gold. Stocks eventually recovered, But only across a long time horizon, a 1929 peak buyer wasn't back to even until 1945, doubled by 1950, and up fivefold by 1960. The pattern appeared: cash survives deflation, gold survives currency resets, and equities reward endurance. Fast forward to the 1970s, an entirely different beast. Inflation surged from 7% to 13% per year. Long-term bonds were slaughtered, losing 50% of their real value. But Treasury bills adapted. Short-term yields climbed toward 15% by 1981. Gold became a rocket, rising from $35 in 1971 to $850 in 1980, a 24-fold explosion. Equities went nowhere in nominal terms for 14 years, but dividend reinvestment quietly produced 5-6% annually, and those who held through the malaise were perfectly positioned for the 17% annual return boom from 1982 to 2000. Then 2008 hit, Lehman collapsed, credit froze. Treasury bills became the only unquestioned safe haven, with yields plunging toward zero as investors stampeded toward safety. Buffett was sitting on $40 billion in cash and used it to acquire positions in Goldman Sachs, GE, and later Bank of America trades that made Berkshire tens of billions. Gold, starting the year at $850 per ounce, dipped to $700 during the liquidation panic, but surged once the Federal Reserve deployed $1.5 trillion in quantitative easing. Stocks dropped 57% brutal, but temporary, and recovered all losses by 2013 before compounding more than 400% through 2020. Then came COVID, the fastest stock market crash in history, a 35% drop in just 3 weeks. Again, cash was power. Bill Ackman's credit default swaps surged from $27 million to $2.6 billion. Gold fell briefly to around $1.450, but then sprinted to $2.070 by August 2020, a 42% turnaround. And equities, after the panic, launched into a stimulus-fueled rally. Finally, the 2022 rate shock bear market. Treasury bills went from yielding 0 to 5% within a year, delivering positive returns while stocks sank 18% and growth names collapsed 30-70%. Gold dipped about 3% but did not crumble, and by 2024 it had reached $2.300. Equities recovered sharply in 2023, rising 25%. Once again, the 3-position pattern persisted. 5 crises, 5 environments, 3 survivors. The deeper you dig, the more you realize these 3 positions don't endure because of superstition, luck, or coincidence. They endure because each one is wired into a different fault line of the monetary system. 3 pressure points that govern every crisis, every boom, every collapse. They survive because they are synchronized with the way money behaves under extreme stress. Start with cash and treasury bills, the most misunderstood assets in modern investing. They aren't powerful during normal times. Their power ignites when the oxygen gets sucked out of the system. Deflation is essentially financial suffocation. Credit evaporates, buyers disappear, leverage implodes. Prices fall not because things become worthless, but because liquidity becomes priceless. In those moments, cash becomes more than paper, it becomes permission. Permission to buy when others can't, permission to wait while others drown. Treasury bills go further. They are cash with a heartbeat, repricing at auction so their yields rise with inflation and fall with deflation, always staying aligned with whatever the system demands. They are the one financial instrument governments cannot allow to fail because they are the system's backbone. Then there is gold, the ancient antagonist of monetary debasement. Gold is not an investment in the traditional sense, it is the counterweight to government power. When policymakers print too aggressively in the 1930s revaluation, in the 1970s inflation spiral, during the massive post-2008 quantitative easing, or the colossal COVID stimulus, wave gold reacts with the same cold logic it has followed for 5,000 years. It rises not because the world is ending, but because the measuring stick currency is weakening. Gold cannot be printed, cannot default, and refuses to obey policy. Its supply grows slowly, making it the final refuge when trust in fiat money starts to fracture. And finally, broad market equities, the S&P 500, a system built on evolution. Stocks crash, but they do not stay dead. They regenerate, corporations adapt, replace failing parts, shed dead industries, and reward long-term holders through innovation and productivity. That's why the S&P has delivered roughly 10% annual returns through a century of wars, recessions, stagflation, monetary experiments, and financial disasters. It's not that equities are invincible, it's that the American corporate engine reconfigures itself faster than crises can destroy it. Combine these three and you get something rare, a portfolio that doesn't resist the economic cycle but mirrors it. Cash thrives when everything contracts, gold thrives when currency fractures, equities thrive when growth returns. Together, they form a structure that doesn't need prediction, only patience. A triad built not to win every battle, but to outlive every war. What makes these three positions so unsettling isn't merely that they survived every crisis, it's how they survived. The pattern isn't linear, it bends, it contradicts intuition. It plays tricks on investors who only look at surface level charts. Each crisis reveals a twist, an inversion of expectations that exposes just how blind most market participants are until it's too late. The first twist is the cruel joke played by cash. In euphoric markets, cash is trash becomes gospel. Everyone abandons liquidity to chase whatever asset is running the hottest tech in 2021 housing, in 2006 equities, in 1929. Yet the moment the cycle breaks, cash becomes the rarest and most coveted substance in the entire financial system. Not because it produces high returns, but because it produces freedom. When deflation hits like in the Great Depression, 2008, or the first 3 weeks of COVID, credit evaporates and forced sellers flood the market. In those moments, cash transforms into a weapon of surgical precision. It allows investors like Bernard Baruch in 1932, Warren Buffett in 2008, and Bill Ackman in 2020 to strike when everyone else is drowning. Cash's power arrives exactly when the herd has already discarded it. The second twist belongs to gold, which often rises not during the panic, but during the response to panic. That's the paradox. In the 1930s, gold didn't skyrocket during the crash, it jumped after Roosevelt's 1934 revaluation from $20.67 to $35 per ounce. In the 1970s, gold detonated only after the monetary system cracked and policymakers tried to regain control following Nixon's 1971 closure of the gold window. After 2008's liquidation drop, gold surged when quantitative easing flooded the system with printed dollars. And in 2020, gold's sharp rise to around $2.070 followed the multi-trillion-dollar COVID stimulus wave. Gold doesn't merely hedge chaos, it hedges the cost of fixing chaos. The third twist is the most misunderstood of all equities do not survive crises because they are stable. They survive because they regenerate. The S&P 500 collapses in every major shock, sometimes brutally, an 89% fall in the Depression, 57% in 2008, 35% during COVID. But these crashes don't kill equity markets, they prune them. Weak companies die, strong ones absorb market share, and new industries emerge. The recovery phase, 1933 onward. 1982, 2000-2009, 2020 and 2023 after the 2022 bear market is where the real compounding occurs. The twist is simple and merciless. You only enjoy the recovery if you survive the collapse. These paradoxes reveal a truth that's both uncomfortable and liberating. The three positions don't thrive because they're perfect. They thrive because each one becomes essential precisely when the others are under attack. In crises, the system changes shape and these three assets change shape with it. When you widen the historical lens and let the weight of a century of crises settle over the present moment, 2025 begins to look eerily familiar, like the prelude chapters of every major dislocation we've already lived through. The signals aren't subtle, they're glaring, they're loud, but they are only visible to those trained to hear the echoes of past collapses. Start with Warren Buffett, a man who rarely telegraphs anything, yet is now sitting on $325 billion in cash and treasury bills, roughly 30% of Berkshire Hathaway's assets. After slashing positions in giants like Apple and Bank of America, he hasn't carried this much dry powder since 2007, right before the financial system cracked open, and 2019, right before COVID, took markets down 35% in 3 weeks. Buffett isn't predicting a crisis, he's preparing for one, just as he always has. Meanwhile, the world's central banks are behaving as though the monetary foundation is beginning to creak. They purchased over 1,000 tons of gold in 2022, again in 2023, again in 2024, the most aggressive 3-year accumulation since they became net buyers in 2010. China's official reserves have doubled, Russia, Poland, India, Singapore, Turkey all accumulating at a pace that looks less like diversification and more like insurance. They're reading the arithmetic the same way hedge fund titans like Ray Dalio and Stan Druckenmiller are reading it. The U sits atop $36 trillion in debt, and history offers only one long-term outcome for that level of burden debasement. And yet, equities aren't being abandoned. Not by long-term thinkers. The S&P 500 still represents innovation, productivity, and a century-long track record of 10% annual compounding. The smart money isn't running from equities, it's hedging them, surrounding them with unprecedented walls of cash and gold. What's emerging in 2025 is not fear, it's strategy. The same quiet reconstruction of the three-position shield that carried investors through 1929, the 1970s, 2008 COVID, and 2022, the architecture that survives everything is being rebuilt in plain sight for those who recognize the pattern. When you overlay today's signals onto the three-state model deflation, inflation, and growth, a shape emerges. Not a steady expansion, not a clear inflationary storm, not the frozen terror of deflation, but something far more unstable, a hinge point. The narrow corridor between two directions the system does not want to choose. Inflation has cooled. Yes, but not enough to be called victory. It still sits above historical norms, lingering like smoke after a fire. Interest rates remain high, restricting the flow of credit, tightening households and corporations alike. Growth is decelerating. And debt, public, private. Sovereign stands like a monolith over the economy, casting a shadow long enough to reach the next generation. These aren't random data points. They are phase markers. They tell you the system is under tension, bending, searching for a direction. Moments like these are incredibly rare. They are the quiet pauses before the dramatic shift. In 1929, the hinge unfolded into deflationary collapse. In the 1970s, the hinge snapped into inflationary chaos. In 2008, it began as deflation until the Federal Reserve unleashed trillions, forcing the system into inflationary expansion. In 2020, the hinge lasted 3 weeks before policymakers detonated stimulus, sending markets into a surge. And in 2022, the hinge reversed from inflation back toward deflationary pressure through aggressive rate hikes. Right now, we are standing in that same fog-drenched corridor, the place where the economy has not yet chosen its next identity. The next shock could take any of the forms we've already seen. Deflation like 1929, inflation like the 1970s, liquidity failure like 2008, panic like COVID, or tightening-driven drawdowns like 2022. That uncertainty is exactly why the three-position architecture exists, not to predict the transition, but to survive it, no matter which direction the door swings open. People like to imagine that investing is a heroic pursuit, a battlefield where the bold sees extraordinary returns through wild courage or superior foresight. But if you study a century of financial history, that myth dissolves quickly. The truth is far more sobering. Almost cold, the greatest fortunes weren't built by the boldest predictions, but by the quiet discipline of survival. Look at Bernard Baruch in the early 1930s. He didn't thrive because he foresaw the precise month the market would bottom. He thrived because he entered the crash with cash and walked through the wreckage with the ability to buy when entire buildings sold for the price of their lobbies. The disciplined holders of the 1970s weren't geniuses who cracked inflation models. They simply refused to panic, accumulating assets that later powered the 1982-2000 boom. Warren Buffett in 2008 wasn't a prophet of bank failures. He was a man with liquidity when the system was gasping for breath. Bill Ackman in 2020 didn't predict a global pandemic. He just recognized that cash positioned correctly could turn $27 million into $2.6 billion when fear peaked. Again and again, the pattern shows that wealth, real lasting wealth, is a byproduct of endurance. Not speed, not brilliance, not perfect timing, just the ability to stay solvent while others are being washed away. And that's the deeper message hidden inside the three-position structure. Cash and treasury bills aren't glamorous, but they are oxygen in deflation. Gold does not promise growth, but it is a lifeboat when currencies drown under their own printing. Equities are violent in the short term, but unstoppable across decades. Three positions, three pillars, a century of empirical proof. Survival isn't the consolation prize, it's the gateway to every opportunity that follows. Because the real question in every crisis is never, what will happen next? It's, will you still be standing when it does? If this narrative helped you see the century-long pattern that most investors never notice, stay close. There is always another storm forming somewhere on the horizon, and when it arrives, the difference between panic and power is preparation. The three positions survived everything from 1929 to 2022. They may not predict the next crisis, but they ensure one thing that matters far more. You won't be destroyed by it.